Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Byd Electronic International Company Limited Annual Report. Byd Electronic International Company Limited offers a diverse range of businesses and services. At the core of its operations are mobile handset components, modules, and other products designed, manufactured, assembled, and sold in China and internationally. The company's portfolio includes various innovative products such as smartphones, tablet computers, new energy vehicles, AI data centers, smart home solutions, game hardware, unmanned aerial vehicles, 3D printers, and Internet of Things (IoT) devices. Additionally, it provides robots, communication equipment, and other related services. Byd Electronic also offers assembly services for various products, as well as manufacturing and selling smart products and components for consumer electronics. Its extensive range of businesses and services has established the company as a significant player in the global market. Byd Electronic International Company Limited market capitalization of $69 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Byd Electronic International Company Limited holds a significant advantage in their industry. Byd Electronic International Company Limited trades at a higher price-to-earnings ratio of 17 times and a higher price-to-book ratio of 1.77 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 64% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets in equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The company have a dividend yield of 2.03%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors. On the growth side, new energy vehicle business and assembly business have been significant contributors to revenue expansion. Additionally, server business and AI computing infrastructure have also played a crucial role in driving revenue upwards. Furthermore, increased demand for electric vehicles in China, growing adoption of advanced automotive intelligent driving technology, and rising penetration rate of electrification are expected to continue fueling growth. These factors have created a favorable environment for companies operating in the industry. On the other hand, some businesses have experienced decline due to various reasons. The smart terminal components business has been a major contributor to revenue decline. Moreover, slowing growth is attributed to weakening global policy support, which has had a negative impact on certain sectors. The net income of the company experienced a significant decline of 17.61% over a certain period. This decrease is accompanied by a reduction in profit margins, which dropped from 6.94% to 5.99%. The primary cause behind these changes lies in the shift towards selling products with lower gross profit margins. Additionally, an increase in cash inflow due to higher sales of goods also contributed to this decline. The impact of these changes is evident in the company's financial performance. Despite the rise in sales, the decrease in profit margins and net income suggests that the increased revenue may not be translating into substantial profits. This shift towards lower margin products could indicate a strategic decision by the company to prioritize volume over profitability or to adapt to changing market conditions. The combination of these factors has resulted in a decline in both net income and profit margins, highlighting the need for the company to reassess its product mix and pricing strategies to mitigate this trend. The company's financial performance indicates a positive trend in its operating cash flow. According to the extracted summaries, the cash inflow from operations has increased significantly, reaching Rm 18,768 million. This is a notable improvement compared to the previous year, where there was a decrease of RMB 6,714 million. This increase in operating cash flow suggests that the company's business activities are generating sufficient funds to cover its expenses and meet its financial obligations. Furthermore, the statement on page 34 emphasizes that the net cash derived from operating activities will be sufficient to satisfy material commitments and working capital for at least the next year. This confidence in the company's ability to generate positive operating cash flow is a reassuring sign for investors and stakeholders. The company's financial health has shown significant improvement over the past year. A notable change is the decrease in debt level, with interest-bearing bank and other borrowings decreasing by RMB 3,623 million from RMB 10,807 million to RMB 7,184 million. This reduction in debt has led to a substantial decrease in interest expenses. The company's total finance costs have decreased from RMB 520,854 in 2024 to RMB 370,306 in 2025, while interest on borrowings has also seen a significant drop from RMB 447,766 in 2024 to RMB 294,233 in 2025. These changes indicate that the company is better equipped to manage its debt and reduce its financial burden. Overall, these developments suggest a positive trend in the company's financial performance. Management is emphasizing the company's focus on intelligent upgrading and full-chain integration of AI plus manufacturing in key sectors. This strategic approach aims to secure a commanding position in future markets by leveraging its existing leadership in the smart terminal industry while accelerating growth in new energy vehicles and emerging businesses. The company is capitalizing on the accelerated intelligent transformation of the new energy vehicle industry, positioning itself for long-term success. Furthermore, management expects significant growth in the AI data center market, driven by increasing demand for computing power. To capitalize on this trend, the group will focus on its strategic portfolio in servers, liquid cooling systems, and high-speed connectivity products. Overall, management's outlook is optimistic, with a clear vision for the company's future growth and success. By focusing on intelligent upgrading and full-chain integration, as well as capitalizing on emerging trends in new energy vehicles and AI data centers, the company is poised to maintain its leadership position and drive long-term value creation. There is no notable activity in terms of acquisitions or divestitures. The company has not made any significant purchases or sales of assets, businesses, or subsidiaries that would impact its overall operations and financials. As a result, the company's portfolio remains unchanged, with no new additions or disposals to report. The company's financial activities have been transparent in their annual reports. One notable aspect is the distribution of profits to shareholders through dividend payments. According to the records, the company has indeed paid dividends, as mentioned on pages 28 and 35. In addition to dividend payments, the company has also engaged in share buybacks. This strategic move aims to increase shareholder value by reducing the number of outstanding shares. The company's decision to buy back shares demonstrates their commitment to maximizing returns for investors. There are growing concerns about potential disruptions in the supply chain. According to recent reports, a significant threat exists that could impact the smooth flow of goods and services. This issue is particularly worrying for businesses that rely heavily on timely deliveries. The main concern revolves around inventory buildup, which can lead to wasted resources and lost revenue. If not managed properly, excess stock can become obsolete or even damaged, resulting in financial losses. Furthermore, supply chain disruptions can have a ripple effect throughout the entire industry, causing delays and increased costs for consumers. To mitigate these risks, companies must be proactive in monitoring their inventory levels and adapting to changes in demand. This includes implementing efficient logistics systems and building strong relationships with suppliers. By doing so, businesses can minimize the impact of potential supply chain disruptions and maintain a competitive edge in the market. That concludes the financial summary for Byd Electronic International Company Limited. Feel free to comment below, and I will be happy to answer them when possible.